Welcome back to Chapter 3, which is covering the adjusting process. So, before we get started, I want you to kind of think about where we are in the process. When we finished Chapter 2, we had done all of the kind of day-to-day journal entries for Smart Touch Learning. And if you remember, Smart Touch Learning opened or started on November 1st. And if you remember, the last thing we did in Chapter 2 was the trial balance, which was on December 31st. So the first 2 months of operations for Smart Touch Learning. Now, Smart Touch Learning had said, despite the fact that they started on November 1st, they were going to use a fiscal year end. So December 31st is the end of their first year, even though it was only 2 months. And then they'll pick up with January 1 and start the next year, their first full year. So this is where we are. It is December 31st. No matter what day you're listening to it, it's December 31st. We are getting ready to close down our books for the year. We need to prepare our financial statements, close out the books, and kind of wrap up this year so that we can start over on January 1 with a new year. However, before we can wrap that up, we have to make some adjustments to our account. So this is really where we're sitting here in Chapter 3. Now, I hope that, as always, you've either printed out the notes taking handout if you have access to a printer, or you've at least got some paper and pencil so that you can take notes. This first section is going to cover objectives 1 and 2, and then we'll pick up with objective 3, which has us doing a lot more journal entries. So make sure you've got that paper and pencil handy so that you can really engage with the content as we go through it. So the first thing we're going to look at is more clearly delineate the differences between cash basis accounting and accrual accounting. So we've talked about these in Chapter 1 and Chapter 2, but we haven't formally defined these words. So you and I are most accustomed to what is called cash basis accounting. You and I most likely operate our personal finances on cash basis accounting. If you happen to own a small business or work in a small business, they may use cash basis accounting. So cash basis accounting says revenues are recorded when the cash is received, and expenses are recorded when cash is paid. So you and I, again, operate our normal personal finances on a cash basis accounting. You record your revenue, which your paycheck is your revenue. You sold your services to your employer. So you record your paycheck, your revenue, when you get paid. You don't go in every day and say, I'm going to record this revenue that I earned today. You record your expenses when you pay them, probably. Now, cash basis accounting is perfect for, again, us personal finances. It's good for some small businesses, especially if you don't deal a lot with kind of payments on accounts and things like that. A friend of mine owns a hair salon, is a hairdresser, and so she uses cash basis accounting because she gets paid primarily at the time of sale. There's not a lot of accounts receivable, accounts payables kind of going on, so cash basis makes sense for her. However, cash basis accounting is not allowed under GAAP. So large corporations, large companies can't use it. Also, if you're a just large company, even if you're a sole proprietorship or partnership or an LLC or an LLP, if you are significantly large and you again do things where you have accounts receivable and accounts payable and things like that, cash basis accounting isn't really advised. What we use instead, and what we've been learning thus far, is called accrual accounting. And accrual accounting says we record revenues when we earn them, when we do the work, not when cash is received. In fact, we'll learn in Chapter 8 what happens if we never get the cash. What happens if the customer never pays us? We still get to call it revenue. Revenue is a record of how much work we've done, not a record of how much money we've made. Expenses under accrual accounting are recorded when they are incurred. So what that means is, remember, an expense is a cost or service used to generate revenue, or another definition is an asset that's been used up to generate revenue. So we record the expense when we use up the asset. We record the expense when we incur that cost, not necessarily when we pay for it. So again, accrual accounting is required under GAAP, and it's used by most large businesses. So a few more concepts before we really get into some journal entries. One is the time period concept. This just says that we're going to break time up into artificial time periods for a business. That's specifically a year, a month, and then a quarter, which is a 3-month period. If you are subject to SEC jurisdiction and SEC regulation, you are required to submit annual reports to the SEC. They're called a 10K, and you're required to submit quarterly reports also. Those are called 8Ks. So a fiscal year can be any 12-month period of time. It does not have to start on January 1, although certainly lots of businesses do choose to start on January 1. It doesn't have to start the first day of business. For example, Smart Touch Learning started in November, but they said, we're going to start our fiscal year in January. A lot of school districts have a fiscal year that runs September 1 to August 31 because that most closely matches their operating cycle. So you can choose what you want your fiscal year to be. Now, the revenue recognition principle, this is a huge, really important principle. I want you to star, highlight, triple underline this one in your notes. Basically, this lays out the 5-step process as to when and how revenue is recognized. And when we use the term recognized in accounting, that means we do a journal entry for it. We record it in our books. So we've always had the revenue recognition principle, but just a couple of years ago, in 2017, I believe, the FASB issued a new revenue recognition principle that really updated and kind of delineated some of these processes. So they've identified a 5-step process. Number 1, there has to be a contract with a customer. It doesn't have to be a written contract. You can have an oral contract, but you have to have a contract with a customer. And then there's identifiable performance obligations, meaning this identifies what exactly we, the company, are expected to do in order to earn this revenue. We've delineated specifically what the transaction price is, so we know exactly how much the customer is expected to pay us. And then for contracts that may take place over time, for example, a long-term contract, we have allocated the transaction price to the specific, performance obligations. So what that means is, let's say that we are a contractor and we build houses. We've identified for all the steps how much revenue do we get to record based on how many steps we've followed. So when you get, for those of you that are going to be accounting majors or go on to the university and take intermediate accounting, this is something that you spend a lot of time on, is going through and kind of really digging into this revenue recognition principle. And then the last step is you recognize revenue as you have satisfied each performance obligation. So let's say that this is a 4-step process and we've completed 2 steps, then we get to identify that much of the revenue. And then when we complete step 3, we get to recognize some more revenue, and then step 4, the final revenue. Now, to go along with the revenue recognition principle is the matching principle. And again, you want to star, highlight, triple underline this one in your notes. The matching principle you'll also sometimes hear called the expense recognition principle. And so it is referring to when we record expenses. So we know that expenses should be recorded or in the period that they are incurred. Expenses have to be matched against revenue. So let's go back to our definition of an expense. We said is the cost or service of providing revenue, or the asset that's used up in the generation of revenue. So the key is that we are using up these assets, or we are incurring these costs in order to generate revenue. So we have to record the expense in the same time period that we record the revenue. So if we incur these expenses now, but we don't generate the revenue until, let's say, next year, we're not going to record the expense until next year. It has to be matched in the same time period. This becomes very apparent in the next semester in Accounting 2302 when you're in managerial accounting and we talk about accounting for a manufacturing firm. So if we're a manufacturer, we're buying, let's say, all of these raw materials that we're going to use to make our product, and then even though we've paid for the materials, we've paid for the labor, we've paid for the electricity, all of that stuff is not an expense until the product sells. So it's an asset until the product sells. So again, two very, very important principles, revenue recognition and the matching principle.